Welcome to The Side Quest, a weekly show on the Grep Beat podcast where we interview interesting people adding to the North Carolina startup community. Sit back, relax, and enjoy the show. Hello, my name is Joe Colopy. I am the Grep Beat godfather, and with me, as always, is Sonali of Primordial Ventures.
Hi. Good to see you, Joe. Love the Durham Bulls hat that you have on today.
Thank you. And I have not gone to a game yet. Have you gone to any Durham Bulls games?
I haven't gone to a Durham Bulls game, but what do you mean you haven't gone to a game yet? Like this season or generally?
No, I definitely have gone to a zillion games.
Okay.
Oh, before we get sidetracked on that, I forgot a couple week elements. It is the week of May 12th-ish, and we're enjoying warmer weather from Durham, North Carolina. And our guest today that we'll have on in a minute is Zack Mansfield of Conductor Capital. I'm looking forward to asking him lots of really interesting questions in terms of what they are up to. But before we get into that, Sonali, you had a bit of a drive this morning.
I did have a bit of a drive this morning. So I drove from Richmond to Durham this morning because my family lives in Richmond. And I was booking it in the left lane. I think, actually, I'm not going to say the speed because just for legal reasons, I don't really know.
Sonali, I've driven with you before, and I would say you're a very cautious driver.
Okay, there's a lot of propaganda around this, and I don't appreciate that because I've been at a lot of startup events recently where founders have actually come up to me and said, so I've heard that you're a really slow driver. And I'm like, where could you possibly be getting this from? And I blame you and Jen.
That's probably from Jen. I'm going to ask one quick question, and then we're going to transition to our guest. But I'm going to ask you this question, and you only just have to answer the question with no commentary or anything else. And I just want the listeners and the viewers to just fill in the blanks, whatever they want. Does that sound fair?
Sure.
Okay. Sonali, what age did you get your license? Just a number would be
20.
Well, that's not too bad.
20. Yeah, okay. Not too crazy.
All right. Well, on that note, let's bring on Zack and see what age he got his license. Without further ado, let's hear for Zack Mansfield of Conductor Capital.
What's up, guys? How are you?
Hey, Zack.
Hey.
We want to start off. We're doing great. We want to start off with some really important questions. We want to know when did you first, I assume you have one, a driver's license, and where was it? Where are you from? Where did you do driver's ed or take your early driving test?
I got my driver's license the day I turned 16. I grew up in Greensboro, North Carolina, and got it at the DMV in Greensboro. And the day I turned 16, and I got it, and I drove to my high school, and I guess I haven't looked back. It's weird. I have a 16-year-old son now.
You got it and then drove directly to your high school after that and picked up your buddies?
Yeah, went to school. I went to school and parked and went to class, and then I was off. I mean, it's funny. I have a 16-year-old son now, and it's a little bit different nowadays, but he has his license now, and it's full circle.
That's amazing.
I wasn't allowed to get my license until 18. So Sonali, I'm somewhere similar to you.
It wasn't even an allowed thing. I just was so lazy in high school to get that license because I have a twin brother and he got it really early. And so we went to the same high school. We had one car that we shared. So we would just carpool together. And I was like, there's not a need for me to get this at this point yet.
Well, you're also younger, and actually the urge to drive early just statistically is a lot less, right? There are a lot more things to do. It's a lot easier to connect with your friends without seeing them in person. Back in, the late 20th century when Zack and I were coming up, or at least I was coming up, it was maybe a little bit different. So, very cool, Zack. So, so you're driving around as a 16-year-old in Greensboro, North Carolina. And now you're speaking from the heart of downtown Durham. Maybe help us connect the dots. How did a young driving Zack get to financier Zack in downtown Durham?
Yeah, I mean it's been a good ride, no pun intended. So
Ah,
grew up in Greensboro, and lived my whole life there until I went to school in Chapel Hill at UNC. And spent 4 years there. Awesome experience, and did like the business school there at King Flagler for undergrad, and really didn't know what I wanted to do. Although I kind of had this inkling I didn't want to do what I was supposed to do, like investment banking or consulting or something that was
yeah.
like prestigious. And I took a entrepreneurship class. This was, like you said, Joe, a long time ago. And it was much less developed in terms of the curriculum.
Do you remember who taught that class?
Well, yeah, I do, of course. There's a guy, a legal professor named Barry Roberts, who
Mhm.
also had done some entrepreneurial stuff in the area. And Barry Roberts had this class, which was an amazing class because basically he just had entrepreneurs and other folks in the entrepreneurial community come in and tell their stories.
That's
And I
incredible.
remember, yeah, I remember being in that class and thinking, this is what, this is the first thing that's really connected for me. Like, this is what I want to do. I don't really know how to do that, but I think this is what I want to do. And so, um, I didn't have the words around that at the time. I just knew that it felt different than thinking about doing it any of the other things. It felt a little more boring. And so, um, I think that is probably the easiest way to say it was kind of the little, match struck at that point that then became a flame and took me along the way. So, um, yeah, I mean, from there, I graduated and didn't know what to do. I didn't have a job. I was trying to figure it out. I started to connect with some folks in this area and ended up getting a job at CED, which
Wow.
people will know. That was my
Yeah.
first job out of college. Just had connected with them, and they said, "Hey, we need someone that can come help us run some of our events for entrepreneurs, and it'd be a great way for you to build a network." And that's what I did. So did that for a couple of years. Got to meet tons of people in this area. Helped run conferences and events and workshops, and really figure out if this was what
I
I
don't
wanted to
think
do. Was
so many people realize how many folks who are kind of influential in the ecosystem now started their career or had a stint of their career actually at the CED. So
Yeah, it
neat.
was, if you look back, an incredible array of talent that's come through there, and then people who have been able to stay connected to this community. And so yeah, I spent 2 years at CED. It was awesome. It reaffirmed my desire to work in and around startups. And so I made the leap, and I joined a software company that had raised some venture money, and went in, and really interestingly, it was like a complete crash and burn. Like I went in there, and within, a month or two, I was like, wow, I don't think it's gonna work. And I was young enough at the time to not know why it wasn't gonna work. I just knew it didn't feel right. And so, uh, you know, pretty pretty soon after I got in, I was like, this is probably not gonna work, and I need to think about the next step. And I ended up connecting with
Well, so did it work or no?
about yeah. Even after I left, it was gone. And so, I guess the intuition was decent at least. And, but there was a bank that had started,
Mhm.
in late 2005 called Square One Bank. And I knew not a lot about it other than it was a bank that was for entrepreneurs and for venture capital firms. That's all I knew. And I was like, well, that's the world I'm interested in. I've just had this kind of weird experience where I left to join a startup and it didn't seem great. And so my risk, aversion was starting to kick in. And so I was like, well, maybe that's banks are safe, right? And
Yeah.
and so I knew that they worked with startups. And so I connected to someone that, again, I met through CED, and they happened to be hiring right when I needed, to hop out of this startup. And I became an analyst there in January of 2007. And it was awesome. It was a great fit.
Wow.
I'm wearing some Square One gear right here.
There you go.
I'm gonna do that.
So,
And
random interjection on the Square
yeah,
One merch topic. So, I grew up in Richmond, Virginia. Neither of my parents work in finance. There's zero connection there. My dad would go to certain conferences because he works in the biotech space and is networking with other founders. And at one conference, he got a Square One Bank shirt as sort of like a conference goodie and brought it home. And it was the softest, like t-shirt material ever. And so for many, many years, like for easily the past decade plus, that shirt, like 2 or 3 of those shirts have been like the go-to pajama shirt, the gym shirt. Like I went to Busch Gardens with my family and I wore it in line when I was a kid. I remember getting stopped by a man in the line being like, "Hey, do you know someone who works at Square One Bank?" And I was like, "No, I don't know anyone who works at Square One Bank." And now moving to this area, just saying, it's just so weirdly full circle. So just on that merch topic, you guys knew what you were doing with the merch. It was great.
I agree. Square One. It was amazing brand, amazing story, and we've been with that if it makes sense.
Yeah.
And if we do, I will try to loop here to that bit of Square One lore. So
there you go. Amazing.
Yeah, joined Square One, January of 2007.
Well, I don't think real quick. I don't think everyone understands, and this will tie into what you're doing now. When people think about banks, like regular people, they think, oh, I go to the ATM, I go Truist, I have my savings account or whatever. But Square One, more like Silicon Valley Bank, obviously that turned a different direction, was of a different type. Maybe you can explain a little bit of what that was. Yeah.
Yeah, and like to be clear, like I said, I didn't really know what Square One did. I just knew they worked with startups at the time. So this was mid 2000s. So this was January 2007 that I joined. At the time, there was really only Silicon Valley Bank, SVB, that was called really kind of the bank for startups. It had existed for quite some time, and there was a few others. So these are commercial banks who the main customer segment is startup companies, so technology, life science, biotech, et cetera. And the venture capital firms that fund these companies were the clientele. And so, SVB had created a great franchise. The big banks didn't really play in that space. And so some folks thought that it was a good idea for there to be more competition. And so a group of folks thought that the best place to go start one of those would be right here in Durham. It was Richard and Susan Casey and a bunch of folks that they had worked with. Richard and Susan were living in Pinehurst at the time, and they started a bank. And they went through the really arduous process. It's very difficult to start a bank from scratch.
I'm sure.
It's hard to get through the regulatory, hurdles, and to get a new charter is very difficult. And they did all the hard work. They literally sat down at a kitchen table and wrote a business plan and did all that work and got funding. And they did what's called a de novo bank. So basically, instead of buying it like a failing bank, they started one. And that started in Durham, North Carolina in 08, 05, August 8th of 2005. And then I joined a little over a year later in January of 07.
And when you joined, were you joining, because building Bronto, I was in American Tobacco campus for years and years. I certainly remember Square One being on the same campus. Is that where you started?
Yeah, I started there. So when they started the bank, this is some downtown Durham lore. Like they were initially, this is like kind of in the beginning of American Tobacco really emerging. And Bronto was there early and Square One was there early. And so they were initially in the downstairs basement space that was unfinished, that's now the Y.
Oh, yeah.
The Y is now
there.
So that was like unfinished basement that was starting to get put together. And then they did build out that space on the second floor. So second and third floor of the American Tobacco campus. So I walked in on my first day there and worked in kind of a classic like analyst sitting in a pod, and you got all the people, and you're all open office, and we were really creating the bank. I mean, they had little pockets of people in some of the other markets, the venture markets, but the guts of the bank was here in Durham. And we grew a startup of the bank while also serving as our client a bunch of startups. And so it was awesome. It was a great experience. Yeah.
Can you speak a second, coming back so people really understand the difference? So there's one thing to pick a customer segment, right? Startups and venture-backed startups in particular, and venture capital funds and firms. Sure. But what does that mean in terms of banking? Right? What kind of needs do they have such that when I roll up to Truist and get my $100 out of the ATM machine, or maybe people want to get a mortgage through their local bank, that's it's kind of a different set of needs, and why there's a need for something like Square One or banks like that that cater to that group.
Yeah. I mean, the most basic is everyone needs a bank account, right? So you have to bank somewhere. Your bank you need somewhere to put the funds that the capital base that you created for your company, the way to send or receive, payments and customer paying you. So that's the most basic need. And of course, you can do that anywhere. You can do that at any of the big banks. I think the natural extensions of that are their bank services. So eventually, maybe you would want to get some credits if you want to have a loan, or you need some other forms of bank services like a letter of credit because you're getting your first office and the landlord wants to know that you're going to pay them, and they may need some something to support the fact that you're going to pay your rent or things like that. That's what banks do. I mean, banks are kind of this key component of our financial system, which it's fun to make fun of banks because what do you actually do? But the extension of credit, the provision of services that allow money to flow, is just kind of like a key component of any functioning capitalist society. And the reality is that the big banks don't do an awesome job of serving these smaller companies. I mean, they focus.
I imagine assessing risk for loans, the profile of an IP-based startup that is working on software where there's no heavy machinery or a farm is a different level of expertise compared to someone who's, creating small business loans for beauty shops and garages all day long.
Yeah, it's a really strange world. It's called venture debt. It's a strange world because these companies that we all know and love, these fast-growing technology, infused companies, for the most part, early on in their life cycles, they're not profitable. A lot of them that raise venture money are not profitable on purpose because they're trying to develop these new markets or products. And by any natural definition of creditworthiness, they're not creditworthy. They don't have assets, like you said, Joe, and they don't have cash flow. They don't have positive cash flow. And so you have to underwrite them a little bit differently. So you're looking at, the growth rates and what they might become. They're looking at who they've raised money from before and what's the likelihood that they might be able to raise more money in the future. And you're assessing a lot of qualitative factors in addition to a lot of quantitative factors. And you're kind of marrying those pieces together in a way that you hope you'll be able to lend money and get it repaid. Because that's really what banks do. Like, they don't take venture equity risk. They take credit risk, which is different.
Mm-hmm.
So that's Square One. Oh, I'm sorry. Yeah.
No, I was going to say, and I guess this probably feeds into the broader venture debt conversation, but would love to hear a little bit more about how you're viewing the venture debt environment right now. Obviously, with the current climate around AI and technological innovation there, where there are some startups that are incredibly overcapitalized in certain capital hubs, and there's a lot of startups also in the Southeast that are opting for a more capital efficient seed strapping mentality because the cost of tech has gone down just so much. So we'd love to learn a little bit more about how you're viewing venture debt now.
And through that lens, just to kind of transition a little bit, we should talk about what you are doing now. Lead to the path of what you are doing now, because
I'll lead you to the path.
Yeah, because I know this next question is highly relevant in terms of your day to day.
Yeah, sure. So I'll just kind of quickly wrap up the Square One story. So I spent 12 years there. Square One is an awesome ride, full of the ups and downs of any entrepreneurial journey. We actually, took Square One public, so we had to ring the bell on NASDAQ. Super fun.
Oh,
was there. So got the I'll show you. I got the NASDAQ.
Oh my gosh.
Super fun.
Are you in there somewhere?
Amazing.
Yeah, right there. I'm right there.
All right.
I mean,
so cool.
Like talking about like a bank that started in Durham and it got to ring the bell on NASDAQ. I mean, what a fun experience. And I ended up having 12 amazing years at Square One. And then ended up going to help start a similar group at another bank. A group of us left in 2019 and started a group at Signature Bank, which we ran for 4 years. And then I'll quickly touch on the fact that in March of 23, a lot of you remember that there was this crazy dislocation. So SVB failed on like a Friday. And 2 days later, Signature Bank was taken over, and that was the bank that we were working for. So
It's crazy.
it was this wild event in the spring of 23. And out of that, I decided, along with my partner, Drew Patel, to go and build something new within the dislocation. So when kind of craziness happens, it's a great time to go build something new. And so we ended up doing something which is turned into Conductor Capital, which is the fund that we run now, which is a private credit fund. So it's a non-bank thing. We raise capital from investors and we're investing it, but in debt facilities and debt, kind of growth debt products to a similar market that we've been in before, which is high growth technology companies. So that's what we do today. And so Sonali, your question is a good one, which is how do you view lending money to companies in today's environment? And there's a lot going on right now. AI has changed everything. And so we've done a lot over the years with software businesses, and those businesses are changing, pretty considerably right now. I think we view it as there's still a lot of opportunity to lend money to these spaces, that the kind of articles that you read around the death of SaaS and the corresponding, issues with private credit. I think our view is that they're a little bit overblown and binary in the way that they describe it, and that the outcomes are much more nuanced. I do think that one of the advantages of AI is it allows people to build companies in different ways, in more efficient ways than ever before. And so as a result, the way you capitalize those businesses, meaning the amount of money that you raise and how you capitalize the businesses, will change. And we believe that that's going to ultimately be kind of a tailwind for what we do, which is that you won't necessarily have to go raise these gigantic venture equity rounds to go fund these businesses, and that there's going to be ways for founders to retain more ownership and they use some combination of debt and equity in the future, or in a more increasing scale in the future. So we don't play in the pure AI, pure play, building foundational model, things that require massive capital outlays. But I think on the edges, everything that AI is touching is affecting every market. And so we're being cautious as it relates to that, to make sure that there's areas where companies can have moats, because we have to think about, why does this company need to exist in the future?
Yep.
And if you're a lender, the advantage you have is you're at the top of the capital stack, meaning you're the first person that gets your money back.
Mm-hmm.
And so we don't have to be like making bets that generate 10, 20, 100x returns. We need to make sure that we're investing in companies where they're going to be able to repay our loan, and that repayment can happen in a lot of different scenarios. And so we're trying to not make mistakes versus pick the one that is going to be the 20x winner. And that's a really distinct difference between debt and equity.
So Zack, maybe you can give an example. It doesn't even have to be specific, so people understand what, and I think in terms of venture debt or private credit, however you want to describe it, how that would look. What would be a typical stage of and type of company that would have those type of needs? I think a lot of folks out there are exposed to early stage venture when they think of startups, but they don't realize there's other forms of financing, particularly ones that come later in a company's growth trajectory.
Mm-hmm.
Yeah, that's great. Yeah. And I think I'll tell you what we do. And we work with companies that have gotten to, at least 5 million of recurring revenue. So they're typically like $5 to $20 million revenue businesses. And so they've kind of gotten past that initial stage of launching the business and finding, some product market fit and some people that are paying them for their product. And they're trying to scale the business. And that's a good time to start thinking about debt. Like when you're in the early stage, you're trying to figure things out. I think equity is most likely the way that you're going to have to fund the business, because it's taking on more risk. As you're thinking about scaling the business, and especially as you're thinking about the dilution of your cap table, then you start to look at as debt as an option. And so, a good example might be a founder who maybe has raised a little bit of money, or they've somehow financed the business to get to 5, 6, 7 million of revenue. And they're trying to figure out, how do we get to 15 or 20 million of revenue? And we know that there's the valuation inflection points along the way. If we can get bigger, you know, with more scale, you can become profitable, but also you may have options to go sell the business. And so, they may say, well, we could operate, profitably and generate our own cash to fund the business, or we could maybe supercharge a little bit if we were to get some outside capital, but we don't want to dilute ourselves with equity. And so that's a lot of the companies that we talk to are using that, kind of framework to think about their businesses. And we may come in when a company has, I don't know, 5, 6, 7 million of revenue and say, hey, if you needed $2, $3, $5 million of capital, we might be a good fit because they can use that as growth capital. So it's not like, it's not just sitting there. They're actually using it. They're using it to go on sales and marketing or other things they're doing. And then their intention is to grow, but to do it in a scalable way. So, we had a company that we, that did that recently. They were able to extend their runway and also invest in some sales and marketing. And then they completed a transaction and sold the business. And so they repaid our loan and got shareholders all made money. And it was a really good outcome. And the founder was able to retain more ownership of the cap table as a result of, not taking on additional equity capital. And that was a big win for him.
Got it.
Yeah. So when Sonali was asking, they were mentioning the question, the trends in the startups themselves, we talk about AI and other things, but there's also financial trends as well. So when I flip through my proverbial digital Wall Street Journal, it talks about the private credit market. And I don't know if that's talking a slightly different stage. Interest rates move around. That certainly affects things. Have there been any trends that you've seen that have affected you all in the last 5 years, or is it going a certain direction that makes private credit for the segment you're dealing with different than before?
Yeah, certainly trends that have affected. I think the interest rate environment is certainly a factor. The rates had increased quite a bit, so there was a lot of interest in private credit because you could go and investors could generate good returns, kind of double-digit type returns through a credit product versus taking on equity risk. And so that was pretty attractive, and saw this huge run up in private credit as an asset class. It got really, really big. And I think part of that is funds and firms that are many multiples bigger than Dr. Capital took on most of that capital. And so then, when things get really big, then they start to go chase deals, and then credit quality can change. And those are macro trends.
It's like every asset class. You get hot and then it becomes problematic.
Exactly. Yeah. And then obviously the other macro trends that affect this market a lot are the equity markets. So if you think about the options for people, the cost of capital, if you're an entrepreneur and you're looking at what's the cost of capital in the 2021 when interest rates were much lower and, the capital markets were flowing freely and you could go raise money at really crazy valuations, it didn't feel that expensive to go raise equity because the valuations were so high, right? Mm-hmm. So as that has changed a little bit over the last couple of years, people are not wanting to raise equity capital at certain valuations, and so it becomes a nice tailwind for us because they say, "Hey, look at debt as an option to kind of extend ourselves to maybe time the capital markets better on the other side." So I think we're constantly, that's affecting our business, and I think you have to adapt in both ways. But those are big ones that we've dealt with in the last 5 years.
No, that definitely makes sense. So we're kind of wrapping up our time a bit and wanted to really kind of thank you for being on the show, but I think it's worth acknowledging that you're in a bit of an office hub. You guys recently changed office. Maybe talk a little bit about that little, I feel like it's like you go to college, by senior year, you're rooming with all your friends in some mega party dorm. And at my college, we had something called the 10-man, which was this massive dorm or massive suite. It feel like you're in the 10-man of startup venture Durham.
I hope so. Yeah, I mean, I hope so. That was our goal. I mean, I think you've heard it a little bit through these comments. I get really excited just in life around, forming relationships and getting to know people. And, Square One had that energy, and then we met lots of people in this area. And through my work, I've just loved lots of entrepreneurial people here. And so there's a space. We're above Mothers and Sons, an awesome building. We had a friend who was in the space already. They thought they're going to have to downsize. And we said, wait a second, what if we could piece together some interesting people and kind of make our own, like you said, like our own Tin Man or whatever we want to call it. And so that's what we did. We called a few of our friends and other people were looking for offices. And so we have co-founders, capitalists here. We have Adam Smith and Regal have a couple offices in here. Viget, which is a company that's been in Durham for a long time.
Oh yeah,
we have
they used to
some
be a
friends
Broadway
there.
customer back in the
Yeah,
day.
exactly. So Vigit's got an office in here with us, and there's a biotech company. It's awesome. It's like a great collection of people. We're all doing a little bit different things, but I think the goal would be to have a space that it's just fun to come into the office. We learned through COVID that we just need to be around people, and we're excited about it. We've been in it for a month or two, and we'll see what it turned into. It's going to be really fun.
We really look forward to invite to the happy hour, which will clearly be invited.
Well, we'll probably, we'll do that, and we'll just like start here and then pop down to Bloma Caves and walk around this area.
Perfect.
Great.
We
love it. Yeah. Well, Zack, this has been awesome. We loved having you on the show, particularly, hearing your story. I think a lot of folks don't understand private credit or venture debt, and really give a little bit more insight to that. And also the profile startups and even investors, honestly, that you might partner with at what stage where it tends to make the most sense.
Yeah, absolutely. Thanks for having me. Love, the community in the area and all that you guys, and we're fired up about building Conductor here in Durham. And our goal is to grow it here and to grow something that can be a part of this community for a long time.
Love it.
Amazing.
All right. Have a great day.
Thanks so much, Zack.
Take care.
Bye.
Bye-bye.
Thanks for joining. Be sure to follow us through your favorite podcast platform. Now get back to working on your side quest